There is a popular stance from smart traders, or rather, the smart money concept traders. It says follow the institutional money, right? So when you see a large candle and this is an institutional candle. However, do you even know what institutional traders really are and what they are doing in the market? Well, in this video, we're going to be talking about institutional traders, specifically from a very credible source, the CFTC COT report for that matter. So let's see what institutional traders really entail. For us to know what institutional traders are, you need to know how to get the COT report first and foremost. And to get the COT report, it is actually very simple. What you simply do is when you get to the CFTC's website and you go look for the COT data, obviously I assume for you to be talking about institutional candles, you know what the COT data is. Below the COT data for traders, for financial futures reports, right? This is for forex traders and CFD traders, commodity, forex CFD trading, right? What you see is traders in the financial futures explanatory notes. When you see this, I want you to click on it and download it. It's a PDF file, just 4 pages. This is the file right here. It's a very short, simple file. Now, the file, in the body of this file, you will find some information that are absolutely key to your understanding of what the different traders in the CFTC COT report really is. But before we do that, let's open the COT report and I'm going to put a quiz up here asking you guys some small questions. Right here, you see that there are 4 types of traders. There are basically 5 actually, but there are 4 main types of traders here. There's the dealer intermediary, there's the asset manager / institutional, there's the leverage fund, other reportable and non-reportable positions. Now, obviously, I know your mind goes straight to asset managers institutionals, right? Asset managers institutional, follow those guys and trade. I think that is not a smart idea. And I know this is going to sound controversial, but let me show you why I think it's not a smart idea to follow that institutional trader as much as they claim. If you go into the explanatory notes, it's going to tell you that the data which also supports the COT's report is separated into the following category for the TFF report: the dealer intermediary, the asset manager / institutional, the leverage fund, and other reportables. But this is somewhere it gets amiss. They actually explain what all these traders are when they separate it in this manner. So the dealer intermediary, I'm not going to read. I'm just going to leave this on the screen. You can pause the video here and read it because I'm going to be explaining it without looking at that part. Now let's head into explaining this whole situation for you. The dealers / intermediary. These guys are the dealers. Basically, they are the brokers. They are the people who take the other side of your trade. They are the ones who look at your trade and say, okay, this guy is looking to buy, let's find the seller. Or if they cannot find the seller, they sell to you instead themselves. They become the seller. And this guy is looking to sell, then they buy or they find somebody who is willing to buy at that price for that assets which you're selling, which you're trying to sell, basically shorts in the market. This is where it gets a bit confusing, right? The dealer intermediary are the guys who will take the opposite side of your trade. That is for sure. They will take the very opposite side of your trade. They are meant to report all this data to CFTC. But these guys are they are the sell side liquidity. You can see right here, it says the rest of the market comprises the buy side, which is divided into 3 separate categories. So as you can see, what it means is the rest of us, all of us, I'm talking about the big traders, small traders, medium traders, position, hedge, scalpers, whatever you want to call the type of trader it is. The rest of us are the buy side traders. You've heard of buy side liquidity, sell side liquidity stories, right? It's beginning to sound like stories, but don't worry, you'll find out something soon. Now we have asset managers. I'm going to be able to read it directly from here. It says these are institutional investors. Yes, the key term you've been looking for, institutional traders, including pension funds, endowments, insurance companies, mutual funds, and those portfolio / investment managers whose clients are predominantly institutional. It makes sense to follow these guys. Absolutely. It is 210% to follow these guys. Let's see what leverage funds is about. Leverage funds, these are typical hedge funds and various types of money managers. Now, various types of money managers. including registered commodity trading advisors, the registered trading advisors that are supposed to be like the ones that are supposed to be online doing what I'm doing right now, advising you about trading things, but they won't do it. Why? Because they do it for paid services. It's a paid service for them, so you have to pay them for them to give you this kind of advice. Then we have registered commodity pool operators, the CPOs, guys who trade a pool of cash, like a huge pool of hard cash. And then we have unregistered fund identified by CFTC. So they're the ones that also, they don't want to register themselves, but CFTC already knows them, right? Now, the strategy may involve taking outright positions or arbitrage within and across markets. The traders may be engaged in managing and conducting proprietary funding, futures trading, and trading on behalf of speculative clients. I want to clear up something real quick for you, right? I want to clear up something real quick for you. What is the difference between asset managers, or rather institutional managers or traders, and the leverage fund traders? This is a very, very simple topic. Let's really, really make it clear. The asset managers, these are people who trade institutional money. They are not hedge funds. Don't ever say institutional traders are hedge fund. You can see it clearly right here. It says otherwise. Hedge fund traders are not institutional traders. They are hedge fund traders. They are leverage fund traders. Asset traders, institutional traders, these are your pension fund. Do you think your government will take billions, millions and billions of dollars and place it in the market to make profit tomorrow morning? Or the people who are managing this money will be placing it into the market to make money next week or next month? I don't think. Let me make it simpler again. Imagine yourself, you have $60 billion in your trading account. For you to have $60 billion in your trading account, you know how much you ought to have in your real life account, right? And when I say real life account, I mean your bank account. And then you need to know the amount of money you have in other assets running around the countries and the world. Would you take 60 billion in your account to trade so that you will make money to buy Lamborghini tomorrow? I guess not. Why? Because if you have 60 billion, okay, 60 billion is too high. 1 billion is even too high. 500 million, you have $500 million in your trading account. A Lamborghini is not your problem. That is the very, 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 very clear fact you have to establish here. A Lamborghini is not your problem. Companies IPO, that is your problem. Things like Twitter's IPO, X, Facebook, Doge, whatever. But real big Tesla companies IPO, that is your problem. If you have that kind of money, that is your problem. That is where you're looking to capitalize on. And do you think you capitalize that on the markets and you make millions from who? The small time traders and the dealer? No, their money is not enough. They're not going to pay you enough, right? So what do you do with that kind of money when you put that money into a trading account? Well, you trade it for ever growing profits, or basically long-term growing profits. Should I say, when you put that money into a trading account, you're not buying euro against the US dollar because the Donald Trump made a tariff that made you feel pained. No, you're buying euro against the US dollar because you've looked at every goddamn data that has to do with the European government right now, and you've looked at every damn data that has to do with the US government right now, and you're saying that in the next 4, 5, 6 years, that will be a profitable run. What does it mean? The market can sink 10% this morning and you won't shake. Why? Because your stop loss is more than way, way, way away. That is it. Basically, these guys are positional traders. Now, don't get me wrong. Following them is not bad. In fact, following them is absolutely cool. But this is the problem. I just said something. Your stop loss is so far, far away that you getting stopped out is hard. Now, look at you who is trying to follow the institutional traders. You're trying to follow, right? Do you think you have that amount of financial grace if the market goes down 5% right now? No, you don't. Your stop loss has been hit long before it even hit 1%. Those guys, they have the stance. The market can go down 10, 15%, and they are not feeling it. Why? Because they have the financial backing. They would wait for that market to rebound 15% and go back up. You don't. So following the institutional traders, I don't think that makes much sense anymore. Just with this little bit of understanding, this little bit of explanation I have here, it doesn't make much sense anymore. It's not as if it's bad. You can understand where they are focusing on. But trading just because they are buying, you're dead. Like your account is gone, it's finished. Now let's look at the leverage fund traders. The leverage fund traders are basically money managers. Obviously, everybody is trading for profit, including the asset managers. Even the dealers are trading for profit, right? But what are leverage funds doing? They are money managers. They are managing people's money. Basically, they are doing similarly with you and I. They are closer to you and I than any other person is closer to you and I. This is what it means. It's just like you have a Toyota Corolla, right? That is your $1,000 account, right? And you're trying to chase down a Ferrari. Does it make any sense? And not just any Ferrari and not just anywhere. You are chasing Ferrari on that motor speedway that they use in Germany to test the Autobahn. You're running your Corolla along the Autobahn and you're chasing a Ferrari on the Autobahn. Bro, you're not going to win. Not even in the mile. Not even by mistake. You will not win. Unless that car crashes, you will not win. So, who do you chase? Who do you think you can chase with your Corolla? Well, the only thing you can chase is a small M5. You could just chase an M5, but you will not win it, but at least you can chase it. You can pursue it, at least you'll be seeing it as it's going to a good extent, right? You'll see it, but it will not completely leave your sight compared to a Ferrari, right? So, in that logic, leverage fund traders are guys who are driving the M5s. They are driving cars that are fast, but not so fast that they erode, they disappear from you when they take off. That's basically what it is. Why do we say so? The leverage fund traders, they trade normal amount of money, right? It's not really normal, like huge money, but kind of not so far away from where your hand can get to at some point in time in life. It doesn't mean you have as much money as leverage fund traders, but at least you can get closer to that level. What does this mean? These guys, they are trading for profits portfolios. They are trying to show their investors that, hey, we made profit this month. Hey, we made profit next month. Hey, we lost some money this month. And if they are losing, they are not going to be losing big. Don't forget that. They're going to be losing as little as possible because they want to have a good record to tell their investor that, hey, we're making profit so you can pay me commissions. Those are the people you should be chasing in the market. And this is why in my data, I focus more on the leverage fund traders, not the asset managers and institutions. I got this. Why I'm making this video is because I got questioned on why am I always focused on leverage and not talking about the institutional traders. I always say non-commercials, but I'm majorly referring to leverage. Because, again, I'll say it again, it's because the institutional traders are positional traders who are trading for years, not months, not weeks. They are placing trades to take profit in years. And they are not going to be placing their trade all in one bucket. They can be placing their trade once or twice in a whole month over month like that for years. Compare that with leverage traders who are going to be placing trades every weekly, monthly-ish. Who do you think you should follow when you have such a small capital to trade with? It's people who are closer to you, the leverage funds. That is what I am doing in this market. I am simply trading alongside leverage fund traders, and I think that is the best thing us retail traders can trade with. For other reportables, well, these are not placed in the first three categories. This is it. It says the traders in these categories are using the market to hedge business risk, whether that risk is related to foreign exchange, equity, or interest. This category includes corporate treasurers, central banks, smaller banks, and mortgage regulators, credit unions, and other reportable traders not assigned to the other three categories. Basically, what is this saying? You hear people say institutional traders and banks, and you can now see that it's two different things. Institutional traders are not banks. They are not the central bank. I had this thoughts all this while as a trader, but upon reading this document, I realized that central banks are not institutional traders. They trade, they are trying to hedge against business risk, right? They are trying to make profits not because they want to like squeeze everything from the market. They're trying to make profit to offset business costs, to offset business risk. What are you trading for? You're trading for purely profit, and that's what the leverage fund traders are doing. You've been looking at the wrong ball all this time. Anybody that's telling you follow institutional traders, yes, follow the institutional traders, but mind how you follow them. That is basically what I've been trying to say in this video. So I hope you learned something from this video. If you did, do well to hit the subscribe button because a lot more of my videos are going to be like this. And then if you also did learn something, trust me, one of your friends will. So share this video with someone you think may find this information valuable to their trading knowledge. See you all in the next one. Peace.